Welcome to DSCR Investor Loans. Today, we're going to dive into one of the most important financial tools for real estate investors, the DSCR loan, or Debt Service Coverage Ratio loan. If you're an investor looking to scale your portfolio, this type of loan could be your key to unlocking new opportunities. So, what exactly is a DSCR loan? DSCR stands for Debt Service Coverage Ratio. It's a way for lenders to evaluate whether an investment property can generate enough income to cover the loan payments. The DSCR is calculated by dividing the property's net operating income by its debt obligations. Here's a simple equation. For example, if a property generates $100,000 in net operating income annually and the total debt payments are $80,000, the DSCR would be 1.25. This means the property generates 25% more income than what's required to cover its debt. DSCR loans are particularly beneficial for investors because they don't rely on your personal income to qualify. Instead, the property's cash flow is what matters most. This makes it a great option for those who have maxed out traditional financing options or don't want to provide extensive personal income documentation. Lenders typically look for a DSCR of 1.2 or higher, meaning the property earns at least 20% more than its debt payments. The higher the DSCR, the lower the risk for the lender, which often results in better loan terms. At our firm, we can also offer loans with a DSCR as low as 1:1, where the property's income just covers the debt payments. This option is ideal for investors targeting properties with high growth potential or in areas where cash flow may be tighter at the start. To qualify for a DSCR loan, you'll typically need a DSCR of at least 1, a property that generates consistent rental income, a down payment, usually around 20 to 25%, a decent credit score, often above 680. However, the beauty of DSCR loans is that they focus less on your personal financial situation and more on the property's ability to pay its own debt. This makes them an attractive option for both seasoned and new investors. Let's look at a quick example. Imagine you're buying a rental property that generates $6,000 in monthly income, and your debt payment is $4,800 a month. Your DSCR would be 1.25. With this ratio, many lenders would feel comfortable offering you a loan because the property generates more income than it needs to cover the mortgage. With this type of financing, you could buy more properties, scale your portfolio, and build your passive income, all while keeping your personal finances separate from your business investments. If you're interested in learning more or want to see if you qualify, head over to dscrinvestorloans.com or contact us for a free property analysis. We're here to help you unlock the full potential of your real estate investments. Thanks for watching.